I think it's interesting to take a longer term perspective on some of the strategic changes that we've made on the trust. Back in 2013, we made a very significant strategic decision to reduce the domestic exposure on the trust. And at that point, we had more than a third of our assets invested in the UK. That has decreased very significantly, such that now we've only got 5 or 6% of the portfolio invested into UK investments. Conversely, we find great opportunities in the US. Some of the dominant global companies are clearly located there. Many of our top holdings are in the US, and we've now got more than half of our portfolio invested into the US market. In private equity, as I said, we've got a long history of investment into private market opportunities, and recently we have made new commitments to that area for the first time in quite a few years. So we're recommitting to private equity through investment in primary funds, secondary funds, and also co-investments into individual companies. And that proportion of the portfolio, which is now around 7%, is rising once again, having been declining actually for quite a number of years. We've got positions in each of those stocks. They've done very well for us. We've been long-term holders and we've enjoyed very, very strong returns. Each of those companies is really quite different in terms of what they do, even though one can regard them in many respects as disruptive technology in different forms. The common characteristic though is they've got dominant position in their respective markets. And when one thinks about holding those stocks on a forward-looking basis, as with any of the other stocks in our portfolio, we need to consider essentially the fundamental case. What is the fundamental business case for each of these companies? Has anything changed? And what is priced into the market? So in answer to your questions, will we hold them forever? Well, I can't promise that we will or we won't, but it'll be a function of the valuation. In each of those cases we do, our manager still sees upside relative to fair value estimates. But from a fundamental perspective, if something were to change in terms of the dominant competitive position of the company, slowing growth trajectory, or indeed, as increasingly could be a risk, regulatory action, which will necessitate change or a breakup of individual businesses, then that may well prompt a reassessment of each of those individual holdings. Well, I think unambiguously we are relatively late cycle in terms of the global economic backdrop. The expansion has been going for many years now. The bull market is relatively long in the tooth. And I think it's fair to say that risks are rising in terms of the macro backdrop, but also in terms of the market backdrop. It looks like bond markets are sending some warning signs. The yield curve, or certain parts of the yield curve, have inverted in the US recently. The market's now looking for rate cuts. That tells us that the bond markets are not very confident in terms of the growth outlook. And it's important for equity investors to recognise that the underlying economy is important in terms of driving earnings growth for the companies that we hold. So we need to think very carefully and look very carefully at what's happening from a broader macro perspective, because if those warning signs are correct and we are about to enter a downturn and indeed a risk of recession, then that'd be bad news for equities in general. Earnings would likely decline, risk appetite would also recede, and that'd be quite problematic actually from an equity investment perspective. What I would say, however, is that bond markets, while they're sending some warning signs, we don't necessarily see corroboration from other indicators like the labour market or bank lending, for example. So my assessment is, yes, it's relatively late in terms of the bull market. Yes, one should be somewhat concerned about how much further there is to go. But on my assessment, there is still some room for the market to move higher from current levels. We don't think the recession is imminent, and in fact we think that the economy will continue to run some way further. At this late stage in the cycle, however, given risks, we do think it is appropriate to adopt a diversified approach. And again, that's why we have a range of different investment styles, approaches, which we think will serve investors well in the event of any downturn. The US equity market still looks relatively attractive to us. More than half our assets are invested in that area. And I think it is likely that US growth stocks will continue to perform relatively well up to the end of the cycle. As a trust, we also have the ability to borrow, and it's attractive for us, we think, to take advantage of very low interest rates to lock in longer term borrowing. And in fact, we've agreed some long dated borrowing out to 40 years at extremely attractive interest rates. That creates a very low hurdle rate for us in terms of investments. In fact, on a 40-year basis, we're borrowing at less than 3%. If we can make a return above that 3% level, then it'll be additive to returns for shareholders over the longer term. I think it's very difficult to run an equity portfolio on the basis of tweets, and there's a lot of short-term noise clearly emanating from the US and elsewhere. There's a lot of geopolitical risks, there's a lot of global tensions at present, and there's some real concerns about the longer-term risk of geopolitical conflict between the US and China. In fact, the US and a number of other regions, perhaps Europe will be next in the firing line in terms of protectionist policies and tariffs. What do we do about that? Well, we need to separate the noise from the fundamentals. We need to look through some of the short-term volatility, the concerns that may be overstated in terms of policy action, but I don't think that we can forget that some of these potential policy proposals will be detrimental to global growth. And in fact, if we find that they're sufficiently detrimental and indeed push the global economy over into a much slower growth trajectory or recession, then that's going to be bad for equity. So we need to distill the signal from the noise to some extent. And for underlying managers who look to pick stocks in this environment, they need to be very, very aware of the supply chain that their companies operate in and the risks associated with disruption to those supply chains as a function of policy emanating from the US or elsewhere.